Software as a service companies, aka SaaS companies, live and die by their metrics. If you're a SaaS founder or CFO, tracking the right financial KPIs isn't just bean counting, it's your flight dashboard. In fact, running a SaaS business without monitoring key metrics is like flying a plane blindfolded. You might be climbing or crashing and not know which until it's too late. This guideline will quickly walk you through the essential SaaS financial metrics every founder needs to understand and act on. So, why metrics matter? Investors, boards, VCs, and even your own team will ask you the same questions. What is our growth rate, churn, runway? These metrics quantify your business health. For example, a 5% increase in customer retention can boost profits by 25% or more, showing how powerful small improvements are. With that context, let's break down the core metrics. Number one is monthly revenue, or MRR, the lifeblood of any SaaS. MRR is the total predictable revenue you earn each month from subscriptions, and tracking MRR and its big sibling ARR for annual tells you if you're actually growing and if you are, by how much. Customer acquisition cost, or CAC, is the next one. How much you spend to land a new customer. This includes marketing, sales salaries, advertising, all divided by the number of customers acquired. If it costs you $500 on ads and sales efforts to get one customer, that is your CAC. Lower CAC means you acquire customers more efficiently. Keep an eye on CAC, especially when you're scaling. If it's rising, you may be overspending or hitting saturation in your channels. The next one is customer lifetime value, LTV or CLV. How much revenue does one customer bring in over their entire life with your company? This is crucial. If the average customer subscribes for 2 years at $50 a month, their LTV is $1,200. Higher LTV means more value per customer. You improve LTV by increasing retention or upselling your services. Compare LTV to CAC. A common rule of thumb is LTV should be at least 3 times CAC. If it's not, you are paying too much to acquire customers relative to what they are worth to you. It's a red flag for your business model. The next metric is churn rate, both from customer perspective and revenue churn. Churn is the percentage of customers or revenue you lose in a given period. For SaaS founder, churn is the enemy of growth. If you churn 5% of customers monthly, that can snowball into almost half of your earnings by the end of that year. Low churn, say less than 1%, signifies a strong product or market fit and customer satisfaction. Track both customer churn, meaning number of customers leaving, and revenue churn, dollars leaving, which weighs bigger accounts more. And don't forget net churn or net retention. If you upsell existing customers enough, you can offset gross churn. Reducing churn by even a couple of percentage points can dramatically boost your LTV and growth trajectory. The next one is gross margin. Typically, SaaS gross margin ranges from 70% to 90%. Since once software is built, selling it is relatively cost efficient. A healthy gross margin means you have more fuel to invest in R&D and customer acquisition. If your gross margin is below industry norm, scrutinize your cost of goods, perhaps server cost or customer support cost. Maybe they're eating too much. The next one is net profit margin and burn rate. Net profit margin tells you what percentage of revenue is profit after all expenses. Many early stage SaaS companies will have negative profit or net loss as they burn cash to grow. That's okay if it's planned, but you must track the burn rate, meaning how much cash you're losing per month and how the trend is on your growth. A key goal is reaching a sustainable net margin as you mature. even if it's as low as 10%. Founders should know their runway. That's the month's cash left at any given point in time, which comes directly from your burn rate. The next one is LTV to CAC ratio. We touched on this under LTV, but it's so important it deserves its own KPI status. LTV to CAC quantifies return on investment for acquiring customers. For example, if your average LTV is $900 and your CAC is $300, the ratio is 3 to 1. Generally good. If it's 1 to 1, you spend $1 to get $1. This is not sustainable. And if it's 5 to 1 or higher, you might be underinvesting in growth or having room to scale up marketing. Keep these ratios in sweet spot. It's often one of the first numbers the investors and SaaS VCs are asking you. Let's talk about the Rule 40. It's a classic metric for later stage SaaS companies. The Rule 40 says your revenue growth rate plus your profit margin should equal at least 40%. For example, if you're growing at 30% annually and have minus 10% profit, meaning 10% loss, you're at 20, which is below the Rule 40. If you grow 50% with 5% in margin, that's 45%, which is above the rule. This rule is a rule of thumb which balances growth and profitability. It's a quick check of whether you're being too conservative or burning too much cash. Many high-performing SaaS firms aim to exceed the Rule of 40, especially in attractive markets. Founders, these metrics are your company story in numbers. They reveal whether customers love your product or not, if your growth is a sustainable one or not, and how efficiently you run the business. Use them in monthly dashboards and report them to investors. Not to drown them in data, but to drive decisive action. For instance, if churn ticks up, dig into customer feedback immediately. If CAC rises, experiment with new marketing channels or pricing. Remember, behind each metric is a strategy. Better product equals lower churn. A smarter marketing equals lower CAC, etc. With this complete metrics guide, you can speak the language of SaaS, finance, and steer your company with confidence. After all, when you know your numbers, you're not flying blind. You're navigating straight toward a scalable success. Thank you for watching. To stay up to date about the future of e-commerce finances, please subscribe to our channel and don't forget to follow us on social media at ecomhouse.